Hey, good morning, everyone. Welcome to this Tuesday, December 19th, 2023 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes or so as we prepare for yet another trading day. We're getting close to the end of 2023. Excuse me, not a whole lot of additional trading days to go before we'll be into a brand new year, 2024. Again, hard to believe that another year is behind us, but don't blink because it's almost over. Stock market continues to do what stock market typically does this time of the year, late in the fourth quarter. It's going up again. Yesterday, we'll go through all these numbers in just a minute, but yesterday was another strong day. We saw a number of all-time highs set again. This is kind of what I was looking for late into the fourth quarter, a strong rally in U.S. stocks, and that's certainly what we've seen. And currently, we're starting to see some areas maybe that hadn't been doing quite as well, beginning to pick up. And I can't help but chuckle when I look at a lot of others' recaps of the market and what they're forecasting. And I say that because one of the big things that many technicians have been arguing against in terms of this being another secular bull market advance is throughout the year they kept throwing out breadth. Breadth just wasn't strong enough. Market can't go higher. There's not enough participation. It's the Magnificent Seven. There's only 7 stocks that are doing well. That's kind of the messaging that was being sent around. And I kept saying, well, that's really not true, because I would be looking back six months or year to date, and I would see maybe 190 stocks on the S&P 500 that were outperforming the S&P. So it's like, it's really not just these 7 stocks. These 7 stocks are doing well, no question, but they happen to be 7 of the best companies in the world. And they got a lot of advantages in terms of generating new business. I mean, if another area comes up, it's almost as simple as like when AI became like everyday talk, throughout 2022 and 2023. These companies, if they don't already have in-house AI, they just go out and buy a company. They have so much cash. They don't care about higher interest rates. They don't borrow. They've got so much cash in their coffers, it doesn't matter. They have huge competitive advantages. And I think probably at some point, I don't know when it's going to be, but if you remember back in, I guess it was 1980s, when the Bell Company split into all these different companies. I don't think we're too far away from maybe some of these companies, Apple, Microsoft, Amazon, Google. I wouldn't be surprised to see maybe them being forced at some point to split. I don't know when it's going to happen. I don't think it's in the near term, but it's gotten to the point where smaller companies really find it difficult to compete against those big companies. And I, sympathize with them. I do think it's really difficult because a lot of these other companies, I think a company like Zoom is a perfect example, because they're dealing with Microsoft Teams, and Microsoft just bundles Teams up into its packages. And so companies already get Teams when they get the Microsoft suite. So how is Zoom expected to compete favorably against a company that's got such a stronghold on customers throughout the world by packaging certain things that it's just hard. And I watch Zoom every day, and I think Zoom, I look at their numbers are doing great revenue growth, or at least some revenue growth in certain areas. Bottom line's been increasing for a while. They continue to perform well, and yet they can't compete against a company like Microsoft. So I don't know where all that's going, but at some point I think it's going to have to be addressed. Probably not the next year or two, but maybe over the next 5 or 10 years, I could see it. I just think these other companies are getting so big, they're just hard to compete against. Anyway, all right, so let's take a look at what happened yesterday. First, you can see the Dow Jones. I mean, talk about an advance. This is a year from the October 2022 lows. And I know a lot of folks thought, well, we're going to go back down there and retest, or we're going to go back down. We're going to blow through them. This is going to be a nasty bear market. We got an ugly recession coming. I mean, these are some of the things that a lot of folks genuinely believe. And everybody's entitled to their opinion. I don't, fault anyone for coming up with their own opinions, but I just don't see it. Haven't seen it for the last year and a half. Called the market bottom June 2022, and I think what we're seeing now is just what the stock market does after a bear market ends. I pointed this out last summer in my blogs. I think when I called the bottom in June, it was probably in June or July. I wrote an article at StockCharts in my Trading Places blog, and I showed how important it was to be in close to the bottom or at the bottom, because the biggest gains in the stock market come in the first year or two after a market bottom. And we're seeing that. We saw it earlier in 2023. Then we went through, had a correction from July into October. Once again, found another significant bottom in October, which is very normal if you follow history. October tends to be the month where weakness ends and a new day is born. And that's exactly what we saw at the end of October. And now we've been moving higher. And the S&P 500 now is at 4740. The low was 3491. We're talking about 1,250 points, probably 35% now off the bottom off the June bottom a year and a half. The actual bottom of 3491 was last October. It's been 14 months. 14 months. And we're up 35% on the S&P 500 and Nasdaq, much, much more. So probably close to 50%. So again, my point is, you can't just listen to all the rhetoric that's out there now. Breadth, breadth. Can't make this stuff up. So throughout most of the bull market run this year, everyone's saying breadth. It's too weak. There's not enough participation. This isn't a strong market. And I swear here over the last week to 10 days, what I've been seeing with breadth is that we're at an extreme. This has now gotten too far. Market can't go higher because the breadth is too good. It's too good now. A few months ago, 6 months ago, it was horrible. Breadth was horrible. The Magnificent Seven, only ones participating. They're the ones leading the market. Everything else really stinks. And now we're at an extreme. We've gone to an extreme. So sorry, we still can't go any higher. I don't even know how to respond anymore to some of the stuff. Another one was, remember when rates got hiked in March of 2022, and then got a 50 basis point hike in May of 2022, and then in June 75 basis points. I think we had 4 75 basis point hikes, and in the middle of all that, an early part of all that, I called the bottom. And go back and look at the YouTube comments. I mean, I every once in a while look back just to laugh. Because folks would say, a lot of the comments were like, you can't fight the Fed. Where'd you hear that from? Where'd you hear that you can't fight the Fed? Probably from CNBC or other media outlets. Do your research. Just about every single time the Fed's gone through a rate hiking campaign, the stock market's gone up. Do your review, do your history. And so I was just like, yeah, that's not what my research shows. I don't care what the Fed's doing. I care about the 1,000 puzzle pieces that I've put together. Interest rates are one of them. A big piece, granted. But folks said you can't go higher because the Fed. It's the Fed. Now it's the Fed. Well, we saw what happened. Stock market's gone up, like I said, 1,250 points. We haven't had a rate cut yet. Still technically in the rate hiking cycle. And now I've seen articles. I've actually seen 2 articles in the last week that said they believe the stock market's going down next year because rates are going to decline. And usually that means the market goes down. Like, what? Where does all this stuff come from? It doesn't matter what happens. Everyone's always got an excuse. The market has to come down. That's the way we're built. Unfortunately, as humans, we're pessimistic by nature. Stock market goes up more than it goes down. Why do we keep trying to find tops? And why don't we just ride what the market historically does, which it goes higher? There are times that you want to be cautious. There are times those puzzle pieces line up and it says, hey, you kind of want to be careful here. We saw that at the beginning of 2022 and talked about it. But the problem is there's 1,000 puzzle pieces and everyone wants to pick one piece up and say, see, this is last 10 times this has happened, the market's gone down. So therefore it has to go down. Or this puzzle piece, it happened twice or this century. And both times when it happened, the market went down. I could care less. I don't care about any of that. Only thing I worry about is the signals that I like to look at and a really healthy dose of perspective. But anyway, while I'm on all this, I'll just tell you, Market Vision 2024 has now been announced. It's Saturday, January 6th. It'll start at 10 a.m. Going to have a guest joining me. That'll be announced coming up. But a good friend and really good technician and somebody I think everyone's going to they're going to learn something from. But we'll talk about that later as we get closer to the event. We're doing 2 mini series events free. I mean, if you're at least a member at Earnings Beat, you can take out 30-day trial. That's free. But it's 2 free events coming up. One coming up. One was last night. And I did the study of interest rates versus the stock market. And if you haven't seen that, you probably scratch your head and say, I didn't know that. I didn't realize that. I didn't know that the stock market went up those years because of that and didn't go up these other years because of something different with interest rates. It's not always the same. Interest rates go up and down for different reasons. But still, you have folks that say, well, if interest rates go up, that's bad for the market. If interest rates go up, that's, you don't fight the Fed. And if interest rates go down, you don't want to be in the market. It's like you never want to be in the market. There's an excuse for everything. You gotta sift through all of that noise and find the truth. There is truth in the stock market if you're willing to do your research. Anyway, go over to earningsbeats.com and make sure you get registered for these events. Really, what you want to be is just a 30-day trial member. You'll get your invitation. So go over to Earnings Beats, make sure you sign up. Anyhow, kind of got distracted there. So the Dow Jones finished up less than 1 point, but it was up. Up is up, right? 4th straight day of closing at all-time highs on the Dow. S&P 500 up almost 0.5%. The Nasdaq 100 up almost 2/3 of 1%. Mid caps up about 0.2%. Small caps barely up, just fractionally. Sitting up here right now on this island, a big gap down, by the way, would be a bearish development in the short term. That would be an island cluster reversal. Anytime you're in an uptrend and you gap up and then you trade like sideways, kind of on an island, and then you have a big gap down, that marks a top. Now, just like some folks that see negative divergences, they're going to want to jump in as soon as they see the negative divergence. Here, the IWM, they look and they say, oh, we've got a possible island cluster reversal. I'm going to get in. Be careful, because this doesn't confirm until we get the gap down that leaves those candles on an island. We could continue just to gap up and keep going higher. And I think the odds of that are stronger than seeing a significant pullback here. So I don't fight. I've said it before and I'll say it again. I'll keep saying it. I do not fight a secular bull market advance. I get so many questions. Well, what about the overbought conditions? What about the negative divergences? Are you looking at sentiment? Are you doing this? What about this that just happened? That's happened 3 times in the last generation. I'm just telling you, in a bull market, if you understand how bull markets operate, they wait for no one. And unfortunately, I think there's a lot of folks bearish in the market, see the market going up, and some of them are starting to say, you know what? Yeah, the market looks a lot better, but I'm going to wait for a pullback. Sometimes a bull market doesn't give you that pullback. Not the one you're looking for, not that big one. I mean, you're looking back and you're saying, well, let me get back in at those October lows. I'm going to wait until it gets back down there. I'm not sure you're going to see those October lows. Maybe for a long, 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 long time. Maybe we get another pullback and have a double bottom. It's certainly possible. But I'm just telling you, based on the way I study history and what I've seen, I would not be counting on a trip back down to that October low. And certainly not back down to the October 2022 low that a lot of folks are still waiting on. Waited all year. And what did we see? Market just keep going up. Now we're hitting all-time highs. How can you still be bearish? How can you be bearish with all-time highs? Seriously, the stock market's the best leading economic indicator that we have, and it's at an all-time high. What do you think that's telling us? It's telling me some pretty good things. Now, you do have to look at under the surface signals. It's not all about price action. Unfortunately, when market's going down and folks are looking at the market going down, they only want to wait until the market starts to strengthen before they get excited again. Then the market strengthens and then they start pulling out their secondary excuses. Been watching it for a year and a half now. But we're at all-time highs. I mean, I get it. If you're in cash or you're on the bearish side and you're kind of stuck right now, you're waiting on a pullback. I get it. You don't want to take that big loss because what happens, I took a course on money. It was Mind Over Money was the name of the course. And I actually got quite a bit out of the course, but it talked about how we're essentially built as humans to not want to admit we're wrong. And I fight that all the time. If I'm in an individual stock and I'm looking for a key support level to hold, it takes a lot for me to follow that discipline, and it usually works when I do. But you see the market going, up, and maybe your stock's not going along for the ride. And rather than just admit that, hey, this is a relative laggard, sometimes it makes sense to get out. Other times, they do rebound as long as price support's not lost. So maybe while they're consolidating, they're okay. But at some point, you got to say that something's not working. And that's hard to do from a psychological standpoint, because when you pull the trigger and you take a loss, you are admitting that you were wrong. And I don't know if anybody's a Happy Days fan from back in the 1980s and the Fonzie. Remember when he started to talk about when he was wrong and he couldn't say the word. And that was all he could come up with. He couldn't say it. And that kind of characterizes a lot of folks in the stock market. You can't say it. You just can't say you're wrong. So you double down. You double down. You find other excuses. You find things that confirm your bias. It's confirmation bias. It's not easy to look at the market objectively. And some people that have been following me for the last year think that, well, you're not being objective. You're just bullish. My signals tell me to be bullish. I'm not going to be bearish if my signals are suggesting we're going to keep going higher. I mean, my signals were bearish at the beginning of 2022. Ask any earnings beats member. Ask anyone who watched my videos back throughout the first 6 months of 2022. Go back and look at them. I was bearish. We'd have rallies and I would be saying, hey, I don't think this rally is going to stick. I think we're going back down to new lows. My signals were telling me we were going to have problems in 2022. Follow your signal. You got to have conviction. And I agree. There's a very fine line between conviction and stubbornness. But to trade in the stock market successfully, I think you have to have a system where you have belief. And at some point, you've got to set the line in the sand to say, okay, I need to reevaluate and come up with some new beliefs because they're not working. But you got to have beliefs. You got to have conviction. Anyway, let's move on. Look at the sectors. I know I've been kind of meandering all over the place here. Communication services was the leading sector yesterday, up nearly 1%, almost 0.9%. I'm looking at the wrong number here. Actually, up more than 1%, actually about 1.25%. 87 cents is what I was looking at. But moving up to new highs, taking out the November highs, so that's good for the XLC. Staples. Hey, Staples have been lagging, but it doesn't mean they haven't been participating. And this is why, or part of the reason why you're starting to see the breadth numbers improve, because a bull market, rising tide lifts all boats. And even though the Staples group continues to underperform on a relative basis, on an absolute basis, they're going higher. They're moving up. They're just not keeping pace with the S&P 500. That's fine. Actually, that's perfect. I want every group to go up. I mean, now we've got energy, which was downtrending, got down to 80. Now it's back up. Went over 85 yesterday. I think this 85 level is a pretty interesting area of resistance. We're trying to get through it. But energy yesterday up 0.8%. trying to get through that 50-day moving average, which is at 84.71. It did fall back and close just below it at 84.18. But that 20-day moving average now starting to turn up. Let's get through that 50-day moving average. And then I think if we make this breakout, I think we can start using that 20-day moving average as support to the downside, as a break above the 50 to me would signal that the odds are increasing, that energy is beginning another period of higher prices. Looking at individual industry groups, steel. Look at steel all of a sudden taking off. And this is something absolutely that I want to kind of keep an eye on and watch, because if we start to see materials, some of the materials areas really take off, is it because of the stocks or is it because of the underlying commodity? And that's one of the things that you need to evaluate when any of these material stocks are moving higher. Are we seeing the underlying commodity moving up with it, or is it something that's unrelated to the commodity itself? And that's something I'll be looking at into year end if we continue to see strength in many of these materials areas. Broadline retail making another new high, moving back through the 3,200 level, gaining 2.5% yesterday, clearly taking out all the tops previously in 2022, looking good. And then internet stocks. I mean, this is a pretty big area for internet, trying to break through some overhead resistance from back in the summer, again in October, again in November, and here we are in December. And I want to tell you, internet loves the month of January. Loves January. We're 2 weeks away. So if you're starting to get technical breakouts on this group, don't be surprised if we see a big rally in some of those internet names. And I'm talking about Meta, which had a big day yesterday, broke out. Google, Alphabet, if you will. But Google making a run, still got a little bit of room to go. It's not as strong as some of the other internet names. Netflix loves January. Big proponent of the month of January. So we'll see what happens there. But Netflix had a pretty good day yesterday. I saw it was up in pre-market again today, at least earlier. So these are some stocks maybe to think about. And I'm going to mention another one to you in just a little bit in the chart of the day. But let's keep moving. 10-year Treasury yield. Wow, that's probably a record, taking that long to get through the update. But there were some things I just wanted to kind of talk about, get off my chest. Hopefully learning lessons, educational lessons for folks, many of you maybe that are newer to the market are still trying to figure it out. 10-year Treasury yield. So this morning we got the housing starts and permits. Ready for this one? Housing starts for the month of November. The estimate was 1,360,000 units. That was the new or the housing starts number that was expected, 1,360,000. The number that came in, 1,560,000, 200,000 above consensus. Pretty big report there. Permits came in at 1,460,000, which was actually slightly below the 1,498,000. That actually that was the revision from last time. It's actually down from the consensus of 1,470,000. So 1,460,000 is the actual number. So we came in slightly below that, and it was a drop from the revised number near 1.5 million from October. But the housing starts number was a really big one for sure. Let's keep moving. Well, 10-year Treasury yield, you can see. Let me just get a quick update here. I mean, right now we're at 392. We're down about 3 basis points from where we closed yesterday. And I mean, this is the significance of following patterns. This is the significance of watching how the stock market trades. In other words, all of this movement to the upside in interest rates, normally history tells us that we would see huge gains, relative gains in industrials and financials when we see rates going up, if the rates are going up because of the economy. Think about it. If the rates are going up because if the economy is strengthening, that's good for financials. It's good for industrials. That's when these two groups tend to do well. Higher rates, while growth companies could still be doing well, remember, their valuations are based mostly on future earnings. So if they're doing well but not raising guidance and rates are going up, chances are their valuations are going to be stuck, maybe even come down. And that's why when rates go up because of a strengthening economy, we tend to see these groups go up. But as we were going up significantly in the 10-year Treasury yield, I mean, from here to here, what did financials do on a relative basis? From here, they actually went down a little bit. What industrials do? Went down. That's not the way this works historically. Normally, when yields go up, financials and industrials do well. But this wasn't the normal. It wasn't going up because of a stronger economy. The 10-year Treasury yield was going up because of higher inflation expectations. And you saw that with the Fed. What was the Fed talking about? It's been trying to get a hold of inflation, trying to get inflation under control. That's what they've been talking about. So the fact now that we're starting to see some strength in financials while rates are coming down, it's because you have to know why rates went up in the first place. Rates are coming down now, not because our economy's weak. Have you seen unemployment? It's almost perfect. Kind of where the Fed looks for it at, right around 4% level. Have you seen jobs go negative? I haven't. I mean, jobs are staying pretty resilient, even in the face of, a lot of folks said, well, rates are not only going up, they're going up really fast, and that's going to have a big impact on the stock market. I'm still kind of waiting. I mean, yeah, we had a little correction, but we're back at all-time highs. You got to kind of look beyond just the numbers and use some common sense, certainly a lot of perspective. It's not just about this number going higher. That absolutely means this line's going to go higher. Sometimes this line goes higher and this one doesn't. Sometimes relationships don't work. There's a lot of other things in the market at play that you got to be aware of. Anyway, you can see the yields coming down. And I actually agree with many folks who say that when rates start to come down, a lot of times that's a bad thing for stocks. Stocks tend to struggle more when rates are coming down than when they're going up, contrary to most folks who say don't fight the Fed. Until, of course, rates start going back down again, then they come out and they say something about that. But we're going to ignore all that because, well, I talked about it yesterday. You can go get the recording as an Earnings Beats member if you want to see it, last night's presentation on interest rates and how it impacts the stock market. But you got to be aware of history and other things that impact the stock market, besides just picking up one piece of the puzzle and saying, see, this piece means market's going to go down. Well, yeah, but there's probably about 800 or 900 of the 1,000-piece puzzle that says the market's going to keep going up. So yeah, you know what? I could be in a debate and I could take either side of the market at any point in time. And I could argue that the market's going to go down or up. There are signs always. If you're bearish, you can always find something. And that's usually what the perma bears do. They'll just move from one excuse to another. And those who are perma bulls, when the market's going down, they'll do the same thing. They'll look, okay, well, this still looks bullish over here. I know, what I said last month that looked bullish, it doesn't look bullish anymore, but hey, what about this one? Unfortunately, that's where the perma bulls and perma bears live. They live in a fantasy land where they're looking for something to support their argument, and they're not going to change. They can't say they were wrong. Anyway, yeah, rates coming back down, which I think ultimately is good. I think we're going to be in a little bit lower interest rate environment probably for the next couple of years. I expect the 10-year Treasury yield. I have said between 3 and 5%. I think that's primarily where we're going to sit. Could we go a little bit lower? Maybe. But I think the 10-year Treasury yield is likely to be mostly in the 3 to 5% area. All right, S&P 500. It's 9:30, so I'm just going to go through a couple of charts real quick. S&P 500, 4740. We're about 60 points away, actually 80 from the intraday all-time high. S&P 500 getting close. Nasdaq 100. Yesterday was its all-time high close on a daily basis. We're there. Small caps, IWM. Well, still got some work to do to get back up near 240, but we got a big level that we're negotiating, and I believe we're going to go through. Watch 200. If we get through 200, That would be a really big move technically. And I wouldn't be surprised if this just keeps going, kind of like, when we finally got above this level right here. Yeah, we had already made a big move, but once we broke out, we made more of a big move. I'm kind of looking at that here. Yes, we've made a big move, but we've done that 3 or 4 times. I think if we get the breakout, you're going to see more buyers coming in the small caps. So watch that. Transports. Here's the long-term look at transports. Yes, not near a high yet, but strengthening, continuing to strengthen. I think these look good as well. Let me go into, well, first, let's take a look at the at earningsbeats.com. This is my home over at Earnings Beats. But if you go to our homepage, you'll see where you can sign up for a no-cost trial. Also, if you want to register for Market Vision 2024, I'm going to just tell you right now, the best way to come see Market Vision 2024 is to be an annual member at Earnings Beats. If you take out a trial right now, you'll have the opportunity to kind of kick the tires and see if you like our service. Most folks stick with us. We got a pretty loyal group, and there's a lot of reason for that. If you look back at our calls from prior Market Visions and from our calls throughout the years, in our daily market report, we now have a weekly market report and so on. You can check all that out. But if you sign up for a 30-day trial right now, you'll have some time to decide if you want to take us up on our annual offer. If you take us up on our annual offer and you register for Market Vision 2024 as an annual member, there's your cost. 0. All of our annual members come in free. Non-members who are not members at all are being charged $697, and it's worth every penny of it to be there. But if you're an annual member, if you commit to us, we're giving you the $697. We're giving you the event free. If you're a trial member and you haven't decided whether or not you want to go annual, but you still want to come to the Market Vision 2024 as a trial member, it's half off. So you don't pay full price. So if you just want to come to Market Vision, at least give us a 30-day trial, save half the money that a non-member will pay for this. So anyway, you can click on that. When you do, it'll come up and you see everything that's taking place. We got 18 more days to go. Show you a little bit about some of the things we're going to be talking about. And then go back and look. I mean, it's all history has been set. I can't go back and change history. I think the calls that were made over the last 4 years are pretty remarkable. And I'm starting to feel pretty good about where I think the market's going. Still got a couple of weeks here to evaluate the end of the year, but we'll see. I think I'm going to nail it again personally. We'll see. So chart of the day. Let me just show you this chart because you see a lot of stocks breaking out. This one starting to make a move here, as you can see. Yesterday was a pretty good day, rising 4.5%. I noticed the volume starting to tick back up again. And I've said if this stock gets through 16, this is one of those stocks. If you look down here in the internet space, remember, internet loves January. We've got a stock here right on the cusp of a major breakout. Look at the last 2 earnings reports. Massive gap up. Earnings report, massive gap up. This is one that is poised, in my opinion, to run. We had a move up. We got a nice little cup. I think anything to the sideways here represents a handle if it forms. But a breakout right here, 15.5 or 16, if we do use this as a measurement, takes us up into low 20s, maybe 22, 23. So this is a stock that I certainly would keep an eye on. A couple more areas that I just want to show you from a long-term perspective that are breaking out to all-time highs. The more and more companies that break out to all-time highs or industry groups, the better the stock market is. The more areas where shorts can't hide. I mean, if you want to short a 52-week high, go ahead. They usually don't work out well. Just like buying 52-week lows. I mean, I don't like to catch a falling knife, and I also don't want to. I don't know what's that. Trying to stop a rocket. I mean, when you break out to 52-week highs, that's usually a pretty good sign. Anyway, diversified industrials. How about industrial suppliers breaking out new highs? How about Truckers set a new high back in July, now trending high, trying to get back to that high. My point is they had already set the 52-week high from late 2021, already done that back in July. How about industrial machinery? Just set a new high. How about heavy construction? Not a new high yet, but getting really close. Those are all in the industrials. You want to know why the XLI is at an all-time high? Those are groups that are leading us. Leading groups in a leading sector. Finding leading stocks within those leading groups, within the leading sector, would probably be a good thing. That's what we try to do. How about another group that is broken out? Technology. Probably heard of it before. It's only 28% of the S&P 500. So for those of you who think the S&P is going down, just understand that the largest area of the S&P 500 is at an all-time high, continuing to move up. That doesn't bode well for the S&P 500 when its largest group is very healthy, setting new all-time highs. How about some of the groups in here? Semiconductors, new high. Computer hardware. This is where Apple lives. New all-time high. Now, when I look at something like internet, it is not at an all-time high. We actually went down during that cyclical bear market, and we've been recovering nicely and looks good. And it looks like actually we're probably up again today because I didn't think that weekly candle looked that good. So let's take a look and see if we're up this morning. And we are. We gapped higher on the internet stocks again. And let's just go ahead and take a look at the market, and then let's wrap this thing up. We got the Dow Jones up another 64, S&P up 7. Now we're up close to 4750. Nasdaq up another 32. Nasdaq 100 up 21. All of these up a little bit less than 0.25%, somewhere between like 0.1%, 1/4%. Small caps up 1%. Let's take a look at that IWM. Are we above 200? We are close again. Look at the move. I just report the news and I give you the results of my research, or at least I talk a lot about my research. And I try to tell you why I think the market's going to do what I think it's going to do. I would not want to be betting against this stock market. By the way, December 21st to December 31st, that's when, if you look historically at December is one of the strongest months of the year on the S&P since 1950. Its annualized return in the first 15 days of December is near the flat line. Second half of December, 34%, 35%, somewhere in there. That's the annualized return for the second half of December. And where that strength really kicks in is starting on the 21st. And today is the 19th. So we haven't even started what is typically one of the most bullish periods of not only December, but of the year. That's 2 days away. So again, would I want to be betting against this market? No, not betting against it. I don't care that it's overbought. Listen, I'm going to use some of these other signals that people keep asking me. The fact that it's overbought, the fact that we have negative divergences. I know I'm going over a little bit, but here's the S&P. Now, I was talking a week ago going into the second week of December, which historically can be a little weak. And I said, hey, we're breaking out, but we have a negative divergence. When we were breaking out, remember? Talked about the negative divergence? Well, guess what? There's no negative divergence anymore. These can be eliminated, which is why when you break out, you don't just immediately short. I see so many technicians say, I got out. We broke out and there's a negative divergence. Well, yeah, but momentum is starting to build again when you get a breakout. How can you say there's a negative divergence or that momentum is slowing when you make a new breakout and the volume starts to expand? That doesn't line up. That doesn't confirm the belief of slowing momentum. High volume breakouts are not slowing momentum. So yes, the PPO says it's slowing momentum, but we don't have any kind of corroborating price signal yet. I want to see a big reversing candle with that negative divergence, and there is none. We just keep going higher. And now look at what's happened with the PPO. It's gone. That is gone. So you got to be careful. And then, of course, one of the other ones is, yeah, but we're so overbought. I'd suggest, again, you go back and look in history. when you're in a secular bull market advance, sometimes overbought stays overbought for quite a while. If you get out because we hit an RSI of 70, you might be getting in a lot higher, even when the RSI comes back down below 70, because it may just keep on going for a while. We might see RSI 80, 85. Overbought can become more overbought. Anyway, that's basically what I had for today. You can see the market still up, still hanging on, if not maybe building on some of those early gains. And look at that VIX down around 12. And another false signal that a lot of folks like to look at is the low VIX. The low VIX generally results in higher prices for a long time. When the VIX finally gives a bearish signal is when it ultimately hits its low. But let me ask you something. When the VIX is going up, I get cautious when we go above 20. I generally am out of the market. If the VIX is above 20, I'm either out of the market or I'm in something that I'm comfortable with. Maybe I'm not in it. Maybe I'm in partial, or maybe I'm just in the ETFs and I'm willing, some other signals, whatever, are telling me that it's okay. But usually when the VIX is above 20, you want to be careful because we don't know that the VIX is going to top at 20. The VIX might move up to 30. It might move up to 40. It might move up to 50. And history tells us it could move up to 90. If you get in at 20 thinking that the VIX is topping and it goes to 50, you're going to lose a great deal of your portfolio. The VIX going from 10 to 15 is not the same as the VIX going from 20 to 30. They're both 50% moves. But when you make a 50% move with the VIX already at 20, I can guarantee you, and I don't give many guarantees, I can guarantee you the VIX going from 20 to 30 is going to send the stock market down hard. So the problem is, and folks say, no, you want to buy a high VIX, not a low VIX. Well, yeah, if you nail it at the exact top, but I don't know anybody that comes out and waves the flag and says, this is the VIX top. You have to somehow figure it out. The only way you know it for sure is hindsight. I don't know of any signal that tells me for sure a VIX tops or bottoms. But when the market action, when we're going higher and that VIX drops below 20 and then below 17 and then below 13, when it's at this level, this is when the stock market historically gets very bullish and very boring. Like this, just see it. The S&P yesterday up 7. Today it's up 11. Tomorrow maybe it's down 4, and then it's up 6, and then it's up 9, and then it's maybe down 2, and then it's back up 12. And as a bear, it's torture by 1,000 needles. It just continually just drags on and on to the upside while your short positions just slowly go down and down. And honestly, it's just a feeling of despair. So yes, the VIX low ultimately will be a great time to short, but I wish you luck on finding the VIX low. Anyway, that's it for me. Everybody have a great day, and I'll be back tomorrow with our next Trading Places Live, and then also tomorrow at 10 a.m. will be our next Trading Places live trading room. And last week when we did it, one stock I had come up with was which one was it? It was LMND. We got in at 1707, and that stock, I think it was the next day, I got out at 1860. It was almost a 10% move in one day. Those are the things we try to look for in those rooms. If you're a member, even a trial member at Earnings Beach, you can join me tomorrow at 10 a.m. for that trading room. Anyhow, that's it. Have a great day, everybody. Happy trading.